Hello guys, welcome to another video on how to trade cryptocurrency like a pro. In this lesson I will simply let you know candlestick anatomy, candlestick pattern, and how you can make your trading decisions with candlestick. With that being said, let's get started. Anatomy of a candlestick. Before we get to that, let me simply run you through the history of candlestick. Candlestick was owned by Japanese, and what they majorly used it for then was measurement of rice, measurement of their buying and selling of rice hundreds of years ago, and it was not made known to the world until 1800s, and that's when people get to know about it, it gets included in financial markets, and that's why we use it in forex markets, cryptocurrency markets, and other financial markets. So in this lesson I will let you know the anatomy of a candlestick, candlestick patterns, what they mean when you see a candlestick, is it for you to buy or sell or stay off the market, and how you can do your analysis with candlestick coupled with other technical indicators. So the anatomy of a candlestick, you can see this white bodied candle and black bodied candle, where you can also call this white bodied candle a green candle and this black bodied candle a red candle. Let's now look at the anatomy in detail. Let's start with green candle. A green candle has upper wick, this upper thin line, and the lower wick, this lower thin line. If you don't want to use wick, you can use shadow, upper and lower shadow. And for a green candle opens below and closes above. It opens the bottom and closes at the top, while a red candle opens at the top and closes below. They have the same structure other than a red candle opens above and closes below, while a green candle opens below and closes above. When you say green candle, what comes to your mind is that a green candle suggests buying. It means people are buying, the price, the value is increasing. When you see a red candle, it means people are selling and the price is gradually coming down. Now let's look at some candle patterns, what they mean and how you can interpret them. In the video that deals with terminology used in cryptocurrency market, we talked and described and defined what it means to be bullish and bearish. So just a kind of reminder, when the market or trend is bullish, it means the price is going up and people are buying. When the market is bearish, it means people are selling and the price is or value is coming down. So these are candlestick pattern. The candlestick pattern just explaining the shape of a candle and what it means. They either mean two things. A candle will either mean two things, either to buy or sell. And when you hear the term bulls, it means buyers, and when you hear the term bears, it means sellers. So number one on our list on the candlestick pattern is tweezer bottoms, and what the tweezer bottom is used for is bullish. When you see a tweezer bottom, it means bullish, it means you can buy, it means you can go long. And you can see the shape circled with red. You can see a white body at the top and a long tail with beside the red body at the top and a thin bottom tail. You can see when you see a pattern like this, it is called a tweezer bottom, and what it means is that you can buy. If you study this small trend, the trend was coming down, but when it gets to the point at which the tweezer bottom candlestick pattern forms, there was a reverse in the movement of the trend. There was a price reversal in the trend. It means it changes, it reverses from downtrend to uptrend. So when you see a candle like this, twist bottom, take note of the pattern. As a matter of fact, you can get your jotter and pen, draw it down and master it. When you see pattern like this, it means it is time to buy. And another one is tweezer tops. It means, it suggests bearish. It means you can sell. So when your trend, assuming you buy low at the lower of the trend, at the lower bottom, at the bottom of a trend, and when it's keep going up, and you get to a point that you see a candle pattern like this, it means you must exit the market if you don't want to keep holding your coin, if you don't want to keep holding the bag. When you see a pattern like this, it means you must exit. Let me explain what the structure of this candle means. You can see this, you can see the thin, you can see the upper wick, the thin upper wick. The price opened, exactly at the top of the end of this previous candle, and it moved up. When it moved up, excuse me, buyers were in charge, but it gets to a point that sellers disagree, say no, we don't want to be in control. Sellers push the market, they push the price down to that point. And then when another candle open, which is red, which is bearish, same thing happen. Sellers push the price back again. It means it is time to make your decision to sell your coin. If you don't want to sell at a loss, or if you don't want to sell at a very minimal or small profit. Let's move to another pattern, and this time it is hammer. The third pattern, the third candle pattern, the third candlestick pattern, it is hammer. What you use this hammer for is bullish. It suggests a bullish trend, and when you say bullish trend, it means you can buy. So when you are following the previous trends, the previous downtrend, and when an hammer forms, the next thing that happens is there is a price reversal. The trend changes direction from coming down to move up, and you can see how this hammer looks. It looks like a normal hammer. It has a long lower wick and a short body and long lower wick. The lower wick or the lower shadow must be longer, even times 2 of the body. And what you should know, that the body, there may be or no upper wick or shadow. There may be small upper wick or small shadow. And when you see an hammer candlestick pattern, it means bullish. It suggests you can buy and enter the market. Another one, which is the opposite of hammer, is hanging man. When you see a trend like this hanging man, it suggests selling. So when your trends are going up like this and you see an hanging man, this is a form of a hammer. Like I said, it's opposite of hammer. Let's go back. Hammer forms in a green candle. Don't forget, I represent this white with green. When the hammer forms in a green candle, the buying signal is strong, that you shouldn't, you can't afford to ignore. The hammer formed in a green candle. When it forms like that, it means the price is going up. You should prepare to enter the market. And when this hanging man forms, which suggests a bearish trend, it forms in a red candle. When it forms in a red candle, it means sellers will quickly take charge of the market. And as you can see here, the trend comes down again. Before we move on in this lesson of candlestick, I want you to keep practicing. After watching this video, I want you to take up your chart, either on Binance or any exchange that's trading chart, to study these candlestick patterns. The more you study it, the more you get better at it, and the more you quickly remember. So to help you in making your technical analysis and making your prediction. So, and the next candle on the table is inverted hammer. This inverted hammer suggests a bullish trend. As you can see, suggests a bullish trend. The price moved up, but sellers pushed price back down, and the next trend that followed was buyers take charge of the market again, and the trend continued going up. The trend continued going up, and you can see the characteristic of this. When I say characteristics, I mean the structure of an hammer. You can see this structure. You can see this. You can see how the structure is. But mind you, you cannot trade alone with candlestick. You still have to make use of other technical indicators to to compare and contrast what this candlestick pattern means. Now, when you compare it with other indicators, it's actually telling you to actually tell you where the market is trending, if it's going in direction of that candlestick pattern or doing the opposite. So you know the candlestick pattern and make use of other indicators to make your analysis, so that you can have a better and almost impossible to forfeit prediction. And when you see an inverted hammer, it means a bullish trend. And when you see a shooting star, it means a bearish trend. Shooting star is an inverted hammer that formed at the top of the trend. Inverted hammer forms below at the bottom of the trend. Don't forget, you can go back and see inverted hammer form at the bottom or below a trend, while the shooting star, which is bearish, formed at the top of the trend. You can see if you technically look at the candle pattern, it means the price went up, buyers took charge, but sellers said no, we are still in control of the market, and they push the price back downward. So the next candle that forms, red candle open at the top and closes below. And for a next candle to form, next candle will have to form at the closing of another candle. And when it closes below, another candle form at that closing and keeps going down. It means sellers took charge of the market. Don't forget, shooting star means a bearish trend. Bullish engulfing. You will almost see this often. You will see this often in your trading chart. Bullish engulfing means bullish trend. Bullish engulfing is just characterized by small red candles that are followed by a big green candle, and the big green candle forms such that it engulfs, it covers, it eats up two or three previous red candles. When a candle forms like that, it means it is time for you to enter the market. It suggests a trend reversal, suggests a reverse of trend in the market. So bullish engulfing, just as the name sounds, it's for bullish trends. It's a candle pattern you can use to enter the market. And bearish engulfing acts exactly the opposite of bullish engulfing. It's a big red candle that formed at the top of the trend after two or three small green candles. The previous candles are green but small. Then comes a big red candle which engulfs the previous green candles. And I want you to know that when an engulfing candle, either bearish or bullish, engulfs two or three candles, it suggests a strong signal. It suggests a signal you cannot afford to overlook. So when it formed, when an engulfing candle form at the top of the trend, it suggests, okay, boy, you're ready to sell, right? you must sell your coin immediately. Then when it forms below a trend, it means, okay, are you ready to enter the market? Let's get started. It means you can enter the market. And let's look at another pattern. Morning star. The morning star suggests a bullish trend, and this is how a morning star forms. It includes one big red candle, one starred red candle, one big green candle, and the next one small candle form. When you see a candle pattern that forms like this, it suggests a bullish trend. It suggests it is time to enter the market. Let me remind you again, carefully study this pattern and go to your charts to study them also in a live charts, in a live market, to see if the candle patterns are actually doing what I'm saying they do. The morning star, when you say candlestick patterns in this circled area, it suggests a bullish trend. An evening star, just the opposite of this morning star, and when you see it forms like this, a big green candle followed by a small starred green candle followed by a big red candle, suggests selling. It is time to sell your coin. Morning star bullish, evening star selling. You buy in the morning, sell in the evening. How cool. Then spinning top. Spinning top suggests neutral. You can't buy and you can't sell. You can see the shape here. And when you see a trend like this, when you see a candle pattern like this, it means you have to wait for the next candle after it to form finish. The next candle after it will tell you the direction of the trend. When a candle forms like this and when it is in neutral, it means the market is consolidated. It means the prayer from the sellers and the prayer from the seller are in equilibrium. They are up to each other. So you as a trader, all you have to do is sit back and relax and let the next candle form and see how the trend is really going. Doji. Doji also, it can be used as a bearish pattern. These neutral candle patterns can be used as bearish or bullish candle pattern. Where it can be used as bearish is when it forms at the top of a trend. You can use doji or spinning top as a bearish trend. But when it forms below a trend, most time it suggests bullish trend. But like I said, wait for the next candle after it to form to actually know what the trend is saying. And the last two here is white marubosu and black marubosu. White marubosu suggests bullish trend. It means buy, and you can see the shape, just like a long with no wick, no upper or lower wick. When you see a candlestick like that, it suggests buy. You can buy. And when you see a candlestick like this marubosu, suggests selling. Usually it forms at the top of a trend. Bearish candle pattern usually form at the top of a trend. But if you see a bearish candle pattern that forms at the bottom of a trend, it still suggests that the market is still going down. So you don't have to enter the market, suggest the market is still going down. If you enter at that point, you still incur some losses if you are not ready to wait or hold the bag. And that is it about candlestick anatomy and candlestick pattern. Before you go, I want you to take your pen and jot some things down, watch this video again, take note of the patterns, master them, go to a live trading chart, study the candle patterns one by one, and with practice you get better. You don't get better by merely watching this video. You get better by practicing. By practicing you get better. And you're free to reach out to me anytime, even via phone call or a comment in the comment section of this course, I'll make sure your questions are promptly attended to. And that is it about candlestick patterns and anatomy. See you in the next video.